Hey friends, hopefully that's a hint for you guys as to what this video is going to be about. That's right, I'm going to be finally reviewing one of the top dogs. This guy's been around for I don't know how many years, 5, 6, 7, something like that, and he's got a massive following. So I want to actually look at one of the strategies that he's been diving into, one of the strategies that he explains on his channel. And I know this video was made a little bit a while ago, but I think it might still apply. I think it might be really useful. I know a lot of you guys like this guy, so hopefully I don't make fun of him too much. So let's get into it. Alright, so guys, first of all, this strategy is called the best Forex trading strategy for beginners. So if you are a beginner trader, I guarantee this is going to be the best one for you in 2020 at least. In 2021, it's not going to apply anymore. You're going to have to find a new strategy if you're watching this in the future. I'm sorry, but this is the best one for the next 6 months, and then you're going to have to scrap it. Let's jump into it.
What's up, my friend?
What's up, my friend?
In today's training, you'll discover the best Forex trading strategy for beginners. And here's the thing, right? This trading strategy, it doesn't only work for Forex, it can be applied to stocks, the futures market as well. So this trading strategy is what I call the BWAP trading strategy. BWAP trading strategy.
I like it, I like it.
So before I explain to you what this is about, right, I want to share with you the criteria, right, that went through my mind before I decided to share the strategy with you. Number one is that this trading strategy, the pattern has to be easy to spot, because new traders, right, beginners, they are not familiarized with, price action analysis, chart patterns and stuff like that. So I made sure that this pattern is relatively easy to spot. So for new traders, right, they are able to, to catch this. Number two, there must be a sound logic to behind why this trading strategy works. In fact, for all strategy, right, there must be a logic behind why it works. If not, right, you won't have the conviction to trade it. And number three, this pattern, right, this BWAP trading strategy, it must take time, right, for it to happen. Meaning it takes time for the pattern to form. If it forms too quickly, beginners, right, they won't be able to catch it in time. They'll be too slow to react. So I made sure that this trading strategy, it takes time to form, so new traders, they can catch it as well.
First of all, I'll say that actually he's going about this in a very strong analytical way. It's very sound how he's thinking. He's specifically trying to design some sort of variation on a strategy that he already knows, but put a beginner spin on it. And the idea that he's saying that has to be very easy to spot, a lot of the trading that I do is much more advanced, and there's much more steps to it, and that's going to really confuse a beginner jumping into it, but he's trying to come up with something that's just kind of a very simple, do this when that happens, a very easy to follow. You don't need to know much, and that's really cool. It's a question of whether or not this is actually going to be a strategy that works.
So the BWAP trading strategy, right, the long setup, right, goes something like this. The market is in a range, and ideally you want 80 candles or more. So don't have to be 80. Too, anal about this. If you get 77 candles, 75, it's fine as well. But generally, I just put here 80 candles or more.
A big
the more
chunk of candles.
The longer the range, the better. Number two, the price then approaches the highs of resistance and then forms a tight consolidation, otherwise known as a build-up, right? So this is what I'm looking for, a tight build-up at the highs of resistance. Number three, I want the 20 period moving average to touch the lows of the build up to signal to me, right, that the market is about to make a move higher. And number four, I place a buy stop order above the highs with a 3 ATR trailing stop loss. So if you don't understand, all these technical terms, don't worry, I'll share with you a ton of charts and examples, cherry pick ones, okay? I cherry pick it because it's much easier to illustrate those examples so you understand what
that's fair.
This means.
The cherry picking is perfectly fair to explain how this is actually going to work. This strategy is first thought, it's going to be a breakout strategy, but it's going to be it's really showing that the market doesn't want to just quickly wick and then back down. So I think his logic behind this is basically that if it consolidates before breaking out, it's less likely to be a sweep and a manipulation of the stop orders and of the breakout traders and then reverse back into the trading range, which it's very sound idea. I've never actually experimented with something like that. So this is quite interesting.
So as a rough idea, right, let me just sketch you how it looks like. So market is in a range over here, ideally about 80 candles range. Then it comes up to the highs of resistance and form a tight consolidation. So this one is what we call a build up, or what I call a build up. Then you want to let the 20 period moving average, which is this line over here, touch the lows of the build up. This signals to you that the market is now getting ready to break out. Then when that happens, you place a
So I want to say that I don't think the moving average really matters here. He's just using it as a duration of how long it should basically be ranging for or building up for. I think it basically, as long as it builds up, the moving average doesn't matter. It's just kind of I guess it's easy for beginners to spot. Okay, that makes perfect sense.
It's a buy stop order above these highs, just above the highs of resistance. And if the market breaks out, you go long with a stop loss of 3 ATR as your trailing stop loss. So I'll explain how that works with a few charting examples. But first, right, the short setup is just the opposite. Market again in a range, 80 candles or more. You want the price to approach the lows of support and form a tight consolidation. Then the 20 period moving average, it touched the highs of the build up. And then when that happens, you place a sell stop order below the lows with 3 ATR trailing stop loss. So why does this trading strategy works? All right, so let me explain to you a few reasons for it. The first one here, okay, let me just draw this again.
First of all, before he jumps into why the ATR trailing stop works, I'm going to tell you why I don't like it. At any point, the market could move in a large move, and if it doesn't create a base and then move to the next level down, then it could easily come back all the way up and stop you out at any point if you've continued to move your stop lower and lower. So you're actually very, very likely, if you're using a trailing stop, to get stopped out. And then it's going to continue back in the direction. The more ideal way to do this, and I think he's only doing a trailing stop because it's easy for beginners, but the better way to do this is wait for bases to form and then new levels to break, and then move your stop behind those new levels, those new bases, after we've moved to lower lows or lower or higher highs.
Again. So when the market consolidate at the highs of resistance, this is a sign of strength. It's telling you that there are buyers willing to buy at these higher prices. Okay, it's a sign of strength. Or number two, it's telling you that selling pressure has difficulty pushing the price lower. Maybe there's a lack of seller. So whatever the case is, right, this is a bullish factor in your favor. Number two, the volatility cycle is in your favor as well. So I'll explain what this means. So here's the thing, right? The market, right? Volatility in the market, it's always changing. Volatility is not static. It's always, moving from a period of high volatility to low volatility and then back to high volatility again. So you can imagine this, that when you are entering your trade in this build-up environment, this is in a low volatility environment. And when the price breaks out and if volatility expands, right, what does that mean for you? That means that your risk to reward on the trade could be pretty darn favorable. If volatility expand, right, you can see that your risk to reward is pretty darn good over here. And this is what I mean by the volatility cycle is in your favor, because you're entering in a period of low volatility. And the third thing over here is that there is a logical place for you to set your stop loss. You can just set your stop loss below the lows of this build up over here, right? Maybe just somewhere about here. There's a logical place compared to a trader who trade breakout. Let's say a trader who trades breakout, there's no build up, he just simply buys this breakout over here. Where are you going to set your stop loss? If you ask me, right, the logical place, the nearest one is below this area of support, and it's pretty darn far away. Okay, so
It's
this
actually-
is why this
That's actually not, if you're smart enough, a logical place, simply because that's where everyone else's stops are going to be. So the market makers know your stops are going to be there. So it actually makes more sense to put it elsewhere, because then you're not going to be part of the school of fish who gets stopped out when it's manipulated.
trading strategy works. And what does BWAP stand for? It stands for breakout with a build up. Okay? A breakout with a build-up trading strategy, the BWAP trading strategy. So let me share with you a few examples so you know how the BWAP trading strategy works. And by the way, right, if you are enjoying this content so far, hit the thumbs up button. And if you don't enjoy it, right, then subscribe to my YouTube channel.
Do it for me
too.
So
first thing first, if you recall, we are looking for a range, a minimum of 80 candles, 80 bars. So use this tool over here, just plot it from the start of the range all the way. And you can see that right now it has about 83 bars over here.
Okay.
Oops, it's gone.
Okay.
Just do that again.
It's ranging. We
80.
see it.
Okay, if you see the red color box, there's about 83
I don't think you need to
bars
count them.
right now. Okay, so that kind of meet our criteria. So
But
where is
ranges,
the highs of
okay.
resistance? So again, use your tool, horizontal line. I can draw this area of resistance over here. And the price, what is it supposed to do after that? The price to approach
okay.
resistance and then to form a build up. So once it forms a build up, what's next? We're looking for the 20 MA to touch the lows of the build up. So we just pull out our 20 MA and you can see that over here, right, the 20 MA has touched the lows of this build up and it seems to be, you know, supporting this higher prices. If you just zoom in, right, you can see that right now the price, you know, seems to be supporting, right, like kind of supporting this higher prices. So great. So now our third criteria is met. The fourth thing to do is to place a buy stop order above this highs over here, the highs of resistance. And finally, we have a 3 ATR trailing stop loss. And you can use this indicator called the chandelier stop over here. Let me just remove the 20 MA, which is, you see, is this purple and blue line over here. This purple, this blue line. So how this works is that this is actually a variation, right, of the ATR indicator. So let me explain. So this one, the settings for this chandelier stop, right, after you place a buy stop order, you enter the trade. How do you manage the trade? Where is your stop loss? This is where this blue line comes into place, right? This is where our trailing stop loss is. So when the price closes below this blue line, we exit the trade. So the settings for this indicator is 122.3. You can use 123, it's fine as well. So ATR period is just simply the, you know, look back period. I mean the how many time period, right, that you want to use to calculate the ATR value. What is it? The last 20 days, the last 22 days, it's up to you. The important one is over here is the multiplier. I shared with you a 3 ATR because this would allow you to capture medium-term trend. If you want to capture a longer-term trend, you can just increase the ATR multiplier to like 4 or 5, whatever, you know, you wish. So how does this blue line, you know, move then? Very simple, right? Let's say now this is the highest price over here. Okay, and if you pull out the ATR indicator, which stands for average true range, it measures the historical volatility of the market. So let's say the ATR value right now is X. So what this indicator does is that we have a multiplier of 3. So X multiplied by 3 gives you 3X. Right? So let's say the current price now is, let's call it, I don't know, Y. Okay? So Y minus 3X, which is the 3 ATR. It gives you, let's say, Z. So Z over here is this blue line over here. This is simply, right, from this price, you minus 3 ATR gives you this blue line over here. So you can imagine that as Y, as the market price goes up, your blue line, your chandelier stop, right, will increase as well. Okay, and this is what happens as the market goes up higher, your blue line goes up as well. And you only exit the trade when the price closes below the chandelier stop, which happened over here, right? This candle, it closes below this blue line and you exit the trade. And yes, this is a winning trade, and yes, I cherry picked this, and that's because it's much easier to illustrate a concept, right, when it's a winning trade compared to a losing trade. But don't worry, right, I'll share with you loser as well to kind of, you know, manage your expectations. So this is how the BWAP trading strategy works. Moving on, one more example.
Okay, guys, I think I know 2 better ways to do this. Let's look at it. Okay, so there's 2 better options for this in my mind. The first concern I see is that there are multiple tests of this level that he's drawn out as a high, as a breakout zone. So there's a lot of breakout traders similar to himself looking to get into this on a breakout. So the market makers, obviously, they know that these are where breakouts are going to be, these are where stops are going to be. So they're going to be incentivized to do these wicking type patterns like this. and essentially break up and then wick back down and stop you out. Similarly, some people might have been caught in this because it stopped a few people out here after multiple touches and then closed back below. This could have easily dumped back down right after that. It didn't have to break out here, but it happened to. That's the major concern here, and I don't breakout trade because that is extremely common. Extremely common. This is why he's personally cherry picks things, because you're going to see that happen a lot of the time, and that's what's going to make you lose nearly all the time. That's what's going to be your losing case, your losing scenario. In a better case, if we want to then look at this range on a lower time frame and look for that same stop hunt right here, for example, if you zoomed into a lower time frame and you saw a wick below that and stop out of these lows or these lows or something, then we can assume that the momentum is actually shifting to the upside, and then you can actually get in at a lower price and enter below the actual breakout, knowing that the momentum has immediately shifted and then gone into the upside. If you don't see that in this case, which you don't see, your next option is wait for the retest of that zone. The untested order block right here, so it moves up, it doesn't come back until there. This is the first test of that block, right? Because it'll always work in staircasing patterns, right? And that's the first test. So after it breaks out and it's confirmed that breakout with a closure of the candle, because notice how this one closed back within, but you see that closure, then you wait for the pullback into that order block, and then you go for the long. In this case, you would have actually entered right here on that perfect entry on that pullback. And that's just the case. Let's see if we can see that on some of his future examples.
Only exit the trade when the last trade, a concept. Moving on, one more example. New Zealand yen. Okay, let me walk you through step by step again. Step by step with no step missed. Ooh. Okay, so again, this one over here, first thing first, we are looking to identify a range.
Look, I guarantee if you look on a lower time frame, this will look even stronger of a stop hunt below these lows. And then you would have been able to enter right down here. And I'm just assuming that it's going to break to the upside here, just based on what this strategy is, right? And that would have been the first entry case. Aha! We made it better!
At least 80 candles. So, okay, we just use this tool. You pull out from the start of this range till the end of it. You can see that right now it's about 77 bar. Oh, Rayner, it's not yet 80 bars, man. Can we take this setup? There's only 77 bar. Come on, do it 80, right? It's 1, 2 bar difference, 5 bar difference. Just go with it. The concept is what matters, not the exact, setup or whatsoever, right? The concept is what matters. So right now we have about 77, 78 bars. That's fine as well. Okay. Next thing. Identify the highs of resistance, and I see it somewhere about here. Okay, you can see that this market is in a range, and that's the highs of resistance. Third thing, the build up. Okay, over here, there is the build up over here.
So now, look at it.
On hindsight, it's gonna be damn easy to look for build up, but in real time, this is where things get tricky. So let me just bring you back in real time and imagine this at this point in time. This over here, right, you might think that a potential build-up is forming already, and you might be anxious, right, to simply buy the breakout of these highs. But remember, you only want to enter the trade when the market is getting ready to break out. And how do we know when the market is getting ready? So that's where the 20 MA comes into play. When the 20 MA touch the lows of the price, all right, for that to happen, right, the market has to consolidate for a period of time. That means the build-up, right, has to last for a while. So right now, if you pull out the 20 MA, you can see that the lows of this pullback, the lows of this build up is quite a distance away from the 20 MA. So this tells you that nope, the time is not yet ready. You want the 20 MA to touch the lows of the build up. So if you go forward in time, over here. Now the 20 MA has touched the lows of the build up. Now we can conclude that this market is getting ready to make a breakout, and that's where we place our buy stop order above this highs, and then 3 ATR trailing stop loss. Okay, in this case, right, market breakout higher after a while. You can
Okay,
see it
guys.
forms a build up for a while. Then
Okay, guys. So, just to note here, if you were to wait for this sweep here and use that method that I'm trying to make a better version of his, your entry probably would have been here, and your stop is right below that sweeping wick. So you would have gotten an earlier entry and you would have had an extremely tight stop. And that way you can actually bet more so that when your winners win, you're actually winning way more.
this blue line goes higher, and you only exit the trade when the price breaks and close below it. So if you look at this, at this point, the market has touched the blue line, but it did not close below it. So you'll still stay in the trade until it closes below it, which is at this point over here. Okay, so you can see that when it breaks and closes below it, right, the whole thing will kind of distort, and you know that it's time to exit your trade. Okay, so this is New Zealand yen. Another example, euro dollar. Okay, so if you just look back in time. So again, what's the first thing we're looking for? Range market, at least 80 candles. And again, right, I don't have to draw that out. You know which tool to use. Then identify the highs of resistance. Then, okay, if you look at this example, this is a little bit different because you notice that the build up is actually formed outside of resistance, right? So the earlier examples, the build up will form before resistance, before it broke up. But right now it seems to hit resistance first, break out of resistance, and then it forms a build up. And that's fine as well. This is fine as well. So again, next thing we're looking for is for the 20 MA to touch the lows of the build up. At this point, you can see that the 20 MA has not touched the lows of the build up, right? You see over here, lows of the build up is somewhere here. 20 MA has not touched it, so it's not ready to break out yet. So we let it touch the lows of the build up. Over here, it did touch. Okay, over here. Then finally, you can place a buy stop order above these highs, and then use 3 ATR as our trailing stop loss to ride the trend. So what's the outcome for this trade? Winner or loser? Well, to be honest, it doesn't matter. The concept is what matters. The process is what matters. So no results for this one. Move on, next one. Dollar against the Turkish lira.
What?
So again, same concept, my friend. So
Why didn't he show us that one if he's not going to show us what happened? That one was super, super weird. It gapped past the level, and then the gap had to be filled, I'm assuming, and he got stopped out. That's why he didn't show it to us. But he's showing you the concept there. But generally, gaps like to be filled rather quickly, so that's a bad example where you shouldn't have done it. And it's not following his rules, actually, because it built up after. And he was saying it was going to build. It's a bit weird, but ignore it, I guess.
So again, where is the range? Okay, I see the range over here. This is the highs of resistance. Next thing we are looking for is the build up, right? The range, ideally, you want to have at least 80 candles. Then you want to let the price approach the highs of resistance, which is this one over here. Then you want to let the 20 MA touch the lows of the build up. So let's see if that happens. So let me just zoom in and we slowly analyze. So at this point, 20 MA has not touched the lows of the build up, and so we don't enter yet. So at this one over here, you can see that over here, this candle is pretty close already. So it's a kind of like a little bit of a subjective call whether you want to consider it as a touch, right? It's pretty close already. So whether you consider it a touch or not, I leave it to you. Okay, and then if you consider this a touch, right, then what you can do is just simply place a buy stop order above these highs or above these highs. Couple of options here. And if it does trigger, you then use a 3 ATR trailing stop loss. So in this case, you can see that this trade is possibly a losing trade. Market breaks out, then reverse back.
I would not want to be in that
possibly,
trade.
Stopping you out for a loss on this trade over here. Again, as I've mentioned, right, this isn't a trading strategy that will win all the time. There will be winners, there will be losers. So be prepared for it.
So this is exactly what I said was going to be the only reason you lose, is because it's going to do the quick fake breakout and then back in. That's market manipulation. It's an extremely common thing. It's every single direction, and that's why I'm saying wait for the market manipulation on the inside in the direction to break out on the lower time frame, and that's actually going to make things extremely more powerful. Extremely. Please backtest it for yourself. Don't take anything that I say or anyone else online says without your own research.
Okay, one more example before we move on. Bitcoin. I really want to hammer home this chart pattern to you, this concept. So again, Bitcoin, where is the range? So again, identify a range with at least 80 candles. Okay, this is the highs of resistance. You want the price to approach resistance and form a build up. So we let the 20 MA be our guide to let us know that the market is about to break out. You can see that over here, 20 MA has touched the lows of the build-up. In fact, you can see there's more of a higher lows into resistance, otherwise known as an ascending triangle. Okay, then now the 20 MA has touched the lows of the build-up. You can place a buy stop order above this highs over here or above this highs. And if the market breaks out, 3 ATR as your trailing stop loss. So in this case, market breaks out, 3 ATR trailing stop loss is this blue line over here.
So if we notice, we didn't actually really get a sweep here. You could argue that this level here was swept. I just can't see if it's actually closed above, within. I think it might have been, but that could have been a stop hunt on the lower time frame. I know what he's looking at. This is like the daily candles of Bitcoin, so let's take a look at that. Yeah, so this to me doesn't look like anything actually swept anywhere. This line not really sweeping. This would be tough to say in my stop hunt in the opposite direction that this would actually work. But if you did look for the lower time frame, you would see a breakout. You'd see this would be the breakout, I assume, and then the retest of that previous order block. This is where you would have entered using my secondary criteria. You would have entered on that retest after you saw the confirmation of the breakout here. Let's look at the daily again. So the confirmation of the breakout, actually it might have been this one up here, and then you would have used that wick on the retest of this order block here. So you would have gotten in basically the same point, a retest of that order block. It would have also worked.
Okay, and you will hold this trade until the price breaks and close below it. Does it make sense? Okay, so I share with you quite a number of...
Alright guys, so I think that is enough there. I think you guys understand the strategy, and hopefully if I actually made it better, please go and check yourself. Do try these things out. My personal opinion is those aren't super easy to spot, but maybe it's because I'm not necessarily a range-based trader, and maybe I have completely different eyes for a different type of trading. So this could be very easy for a beginner to spot. Personally, that's not what I would ever look for. It's very it's ambiguous of what we're actually looking for. I need clean cut, very obvious. It has to be yes or no. It can't be the range is ranging. That's a very open-ended question, right? Is it ranging or not? It's very, very hard for me to determine if it's ranging because we don't actually really know what ranging means in the terms that at least he uses. So you might have to define a range in other terms like that, but for a beginner it could work. Yeah, that's a really cool strategy. It's a little bit different than some of the other strategies I've seen. I like it a lot. I would really go and recommend that you guys look and you play around with it and apply some of the manipulation tactics to it that I also suggested. I'll see you guys next time.
Listen.